Hi, my name is James Robinson, and this is my stock pick of the week. Every week I try and find a stock which meets the goals of value investing, meaning it's a very solid company with consistent earnings, high returns on equity, something that Warren Buffett I think would consider buying, and something that I think is underpriced. Today we're going to do something different. Today I'm going to compare two stocks in the same industry to each other. The companies I'm going to compare are Marten Transport and Knight Transportation. The reason that I'm doing this is a friend of mine whose son is very interested in investing recently called me and said his son really liked Knight Transportation and what did I think of it. And I thought, well, I like Marten Transport more. But the more I thought about it, I hadn't looked at Marten Transport in a while, and I knew Knight Transportation had just done a merger with Swift. And I just have this theory that if somebody is 16 years old and they're really looking at stocks because they're interested, they might, know something you don't know or have found something you haven't found just because they're looking at things with a fresh eye. And so I thought, why don't I go back and take a look at these, and it'll make a good blog post. So today we're looking at Marten Transportation and comparing it to Marten Transport and comparing it to Knight Transportation. Marten Transport Limited operates as a temperature-sensitive truckload carrier for shippers in the US, Canada, and Mexico. They transport food and other consumer packaged goods that require temperature-controlled or insulated environment. So they're a niche shipper. It has four divisions: truckload, dedicated, where it carries freight for its customers; intermodal, where its trailers are carried some distance on their trucks and then shipped via other modes such as rail; brokerage, where it arranges for third-party carriers to carry freight in its temperature-controlled vans. The firm has 3,492 employees. It has 2,750 tractors, which you and I would call trucks. It's based out of Mondovi, Wisconsin, where it was founded in 1946. The company is a small cap and it went public in 1995. So compare that to Knight Transportation. Knight Swift Transportation is the result of the merger of Knight and Swift transportation companies. Those two companies are both based here in Phoenix, and so I followed the merger that went on there and kind of the backstory with some interest. The company was founded in 1989. It has grown into a $5 billion a year shipping company serving all of North America. Knight Swift is a full-service operator for both retail, food and beverage, consumer products, paper products, transportation, and logistics. It also serves housing, automotive, and manufacturing industries. So really it does everything for the shipping industry. The company has 6 divisions, which serve most facets of the over-the-road shipping industry, including brokerage, intermodal, climate controlled, which by the way would compete with Marten, and flatbed shipping. The company has 23,000 tractors, 9,330 intermodal storage containers, and has 25,200 employees. So it's significantly bigger, many orders of magnitude bigger than Marten. So for the rest of this comparison, I'm just going to call Marten Transport Marten and Knight Transportation Knight. The market cap for Marten is $1 billion. The market cap for Knight Transportation is $5 billion, some $5.8 billion, so almost 6 times as much. The revenues are $787 million for Marten, $5.34 billion for Knight. Profits are $55 million for Marten, $419 million for Knight. The PE ratio for Marten is about 18.7 as of the day I'm doing this analysis, and for Knight it's 14.27, so Knight seems to be cheaper based on its earnings. The dividend yield is slightly higher for Marten at 0.84% versus 0.71% for Knight, but in neither of these cases is the dividend big enough that it would justify me buying the business or buying the business one over the other. The big difference between these two companies, and the reason that I like Marten a lot, is that Marten has zero debt. I like companies with zero debt, whereas Knight Transportation has $929 million, so effectively $1 billion in debt. So in terms of scope, Marten has 2,755 trucks. Knight has 23,000 trucks. Marten's revenues are $285,000 per truck, whereas the revenues for Knight is $232,000 per truck. So again, I like Marten that its trucks seem to be generating more money per truck. The profits per truck for Marten is $19,000, and the profits per truck for Knight is $18,000. So still, again, Marten does seem to be doing a better job of utilizing the efficiencies of its trucks. So this is a look at the gross margins, and you can see that the gross margins for Marten are significantly higher. They're in the top 10%, and the gross margins for Knight Transportation are the other extreme. They're significantly lower. I think this is a bit misleading, though. There's some costs that Marten seems to be calling selling general administrative that I think Knight is calling operating costs, which is their cost of goods sold, which is pulling this number down. But suffice it to say that in terms of gross margins, Marten is doing a significantly better job, and to me that makes it more attractive. So here you see the earnings per share diluted for Marten and Knight. Again, both these charts are pretty sensible. They kind of start low and go up every year, or generally every year. They both had crazy good years in 2017, and again, more in line years in 2018. There's nothing much here to pick one stock over the other. They're both solid companies, and one of the things that this tells me, this is a good industry, right? Multiple companies in the industry perform well. Tells you maybe it's a solid industry and you want to be involved. It's not one company sort of bucking a trend, which oftentimes can be a sign that there's something going on goofy with the books. So here we see net earnings per revenue. So this is out of every dollar they earn, how many dollars reach the bottom line. You can see that neither of these companies is sort of significantly above average. They're both sort of in that line, somewhere between 25, the bottom 25 and the top 55. Knight is slightly higher, again, not significantly and not enough that it would make a big difference, but Knight does sort of win this battle a little bit, and so, credit where credit's due. So you remember when I was talking about gross margins, I said that I felt that the gross margins for Knight probably were artificially high. I think that that's because they've chosen to account for some of their cost as cost of goods sold versus selling and general administrative, because Knight's selling and general administrative is very low. It's in the bottom 20, it's in the top 25% and has been as high as the top 10% of companies. It seems to me that that's hard to do in a trucking company, especially when you look at other companies in the industry. Marten Transportation's, significantly higher, again, somewhere in the middle of the pack. And so again, I think that this is the reason you got to look at multiple charts. You got to really try and understand what's going on with the company. But these things were so divergent. The gross margins were so high for Marten and so low for Knight, and then those two things are flip-flopped here. It just seems obvious to me that that's really what's happening with the books in these two companies. So while the advantage here is to Knight, I think when you compare it and you add it all up and you look at Marten and Knight, gross margins versus selling and general administrative, I think that kind of works out to be close to a wash. So here we can see plant equipment and assets as a percentage of cost. So when you first look at these charts, it looks like Marten is significantly higher, but that's really artificial. That's because the cost for plant and equipment and assets for Knight Transportation were extraordinarily high in 2017. And if you remember, Swift and Knight Transportation merged in about a merger of equals. And so you can imagine there would be a whole bunch of costs that were kind of screwy that year. And so what you saw is that the cost of plants and equipment was astronomically high that one year as a one-time blip, and then it's artificially low again this year, probably because they spent a bunch of money last year and they didn't need to spend it this year. So I think you need a year or two for that to normalize. But if you look at these charts, they're both, in the bottom 5% of companies in terms of plants and equipment, and that just makes sense. These companies own thousands and thousands of trucks, and they have to have, places to repair those trucks. So they need to have, 10,000 storage containers and refrigerated tractors. And I mean, these things they cost a lot of money. They did get decent returns on assets and returns on equity, but they are going to have a lot of assets in this business. And so while again, these charts look like they're off, they're really not that divergent from each other. So this is, again, one of the places that Marten really does shine over Knight. But again, with Knight, it's semi-artificial. So you can see here that Marten has no debt, has consistently had no debt. The current liabilities kind of have been going up, but that's because they're making more money. They're getting bigger, presumably. So they've got, more obligations they have to meet every month to kind of pay the bills. The most debt they've ever had, was way back in 1999. They had, almost $90 million worth of debt, but they really paid that down. They had, 5 or 6 years ago, they had $30 million in debt. They paid that back down. So this is a company that likes to be debt-free and works hard to do that. The story for Knight Transportation isn't much different until last year when they did that merger with Swift, and then they took on almost $1 billion of debt. And I just don't know how long it's going to take them to pay that off. And I don't know if they're going to really like this mergers and acquisition bug and do a bunch more and pile a bunch of more debt onto the balance sheet. And so this is really indicative of my problem with Knight. I don't know what's happening with Knight. I don't know how efficient they're going to be in this Swift merger. Are they going to get rid of a bunch of dead wood? Are they going to take on costs they shouldn't? And so my problem with Knight is I just think there's less transparency towards the future. Marten Transportation has no debt. It's going to keep trucking along, doing what it's doing, hopefully taking a little market share from its competitors. Hopefully it has some pricing power. It's got its little niche. It's trying to just do that, refrigerated shipping. And Knight is trying to do everything, and they're just going to grow and grow and grow. And I just don't know if that trend's going to continue. And I don't know how good they're going to do at doing that. And so really my reason for not liking Knight, the biggest reason is, and this chart shows it, I just can't predict what's going to happen next. And I like companies that if I bought them, I could forget that I owned them for 10 years and be reasonably comfortable that they're going to continue to be doing the same thing 10 years from now in terms of revenues and profits that they're doing now. So interest expense, basically Marten pays no interest and Knight Transportation pays $30 million. It shows that Knight's having some interest expense for the first time in a long time, but it's really an irrelevant number. It's less than 10% of profits. It's not a big deal. It's just that, I wanted to show that one company's got no interest expense because it has no debt, which is an advantage for Marten, and that Knight has some and it's growing, which is a disadvantage. So interest coverage ratio, that's the company's basically its ability to pay its debts. And Marten Transportation has, my minimum interest coverage ratio that I like to look for is 1.5 times. Marten's is at 2.25, so significantly above my minimum margin. And Knight Transportation, their interest coverage ratio has been dropping really every year since, their coverage ratio has been dropping every year since 2009, really. And now it's really right at my bottom line. Now, the good news is it's right at my bottom line, been there for 2 years, which means they're sort of cognizant, that's sort of their bottom line too, and they're going to control that. I wouldn't be surprised if this number improves for Knight Transportation over the next couple of years. But again, I don't know that, and so I have to give the nod to Marten. So here's current assets to current liabilities. Both companies have more assets than they have current liabilities by a significant margin. Both companies have done that for a very long period of time. I think that there's no real advantage one over the other here. Again, this is just showing that both companies are very well capitalized in terms of current assets and don't have current liabilities that are out of whack. This is another reason why I like Marten Transportation over Knight, which is dividends. You can see the dividends have effectively gone up pretty significantly every year since 2010. Neither of these companies do a great job of paying dividends. Neither of them is a stock I would say buy because it pays dividends. But Knight hasn't increased its dividends since 2010. That's despite having its income and its profits going up all the time, and I'm wondering what they're doing with that money. Whereas Marten just pays a little bit more every year, and sooner or later it might end up to be a reasonably good paying dividend stock. So here you can see cash and cash equivalents and marketable securities to total debt. Again, total debt is long-term debt as well as current liabilities. So both companies don't have enough cash on hand to pay off all their debt. Frankly, not very many companies do. But if you look at the gap here for Knight Transportation, it's very, very significant. And if you look at the gap for Marten Transport, it's really pretty irrelevant. It's less than a year's income to bridge that gap. Whereas for Knight, it's several years' income to bridge that gap. So again, better capitalized relative to its expenses and debt is Marten Transportation. So shareholders' equity. Marten Transportation's shareholders' equity sort of just seems to go up a little bit every year. Bump, 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 bump. We like that. It's consistent. It's predictable. They seem to be doing a good job. Knight Transportation, by the way, their chart wouldn't look much different if it wasn't for this gigantic bump they had when they did the acquisition with Swift. The problem is, again, I don't know if they're going to be able to return great returns on shareholders' equity now that they have so much more. I don't know how much of this is accounting and how much of this is going to be, cleaned up over the next several years as sort of the effects of this merger start to shake out. So I just put less stock in knowing what's happening with Knight Transportation. Doesn't mean it's wrong. It doesn't mean that this could be very legitimate. This merger might have been spectacular. I just don't know. So return on assets, which is more important to Marten than it is to Knight because Marten doesn't have any debt. So this is really the same thing as return on equity. They're sort of barely in the top 25, but the last few years they bumped it up and done much better. Now they're in the top 25. And Knight has gone the other way. Even with the merger, Knight has gone from being almost in the top 10 5 years ago to not being in the top 25. So their return on assets has dropped, and and Marten's has gone up. And so I have to give the nod to Marten in this category. It's not a big deal. It's not a gigantic difference, but the trends are going in the favor of Marten as opposed to the favor of Knight Transportation. Return on shareholders' equity, again, it's the exact same shaped chart. For Marten, its returns relative to other companies are lower. They're really sort of exactly middle of the pack. And that's because they have no debt, and so they're not leveraging these returns. Knight, unfortunately, even despite the fact that it's taken on $1 billion in debt, is going the wrong way again for the last 4 years. You'd like to have seen, as they're taking on debt, at least the return on shareholders' equity increasing, and that doesn't seem to have happened. So this is a kind of, in my mind, a relatively big knock on Knight, because I really like return on equity. I really like return on assets. I think it's an important measurement, and Knight is going the wrong way, and has been for several years, and has been even though they just did this merger. So this is a big knot on Knight Transportation. So here are some additional thoughts to think about when comparing Knight Transportation to Marten Transportation. Knight just did this Swift Transportation merger. We don't know yet how well that strategy is going to be and whether or not it would be beneficial to shareholders. But I would argue that either way, whether the merger is great for Swift Transportation shareholders or is bad for them, it will accrue to a bigger benefit to Marten. And so why do I say that? Well, if it turns out that the merger was a bad idea, Marten didn't make that merger, and so they're going to look comparatively better and better relative to Knight. So that benefits the stockholders of Marten, because we don't have the negative, right? If, on the other hand, it turns out the Knight-Swift merger was a spectacular success, and it created all these efficiencies, and it created pricing power that they didn't otherwise have, the ability to drive tougher prices with their employees because they're one of the only players in town. Whatever the benefits of this merger might be, if those things do in fact come to pass, well then Knight and other large shipping companies are going to be looking for somebody else to merge with. And in that case, I think Marten is a fantastic option. The CEO is in his mid-60s, getting older, been running the company for a long time. He may be ready to retire. It's a relatively closely held company. And if he decided to retire, he could easily sell this company and merge it. And if the Knight-Swift merger shows these mergers work and are profitable, that enhances the value of Marten as a takeover target, or as a friendly merger in that case. So when you look at Marten, also has zero debt. So when you look at all those things, it does look like the merger can only accrue to the benefit of Marten shareholders disproportionately to Knight shareholders. It's also important to note there's zero chance that merger will go the other way, right? Like, we can't imagine a scenario where Marten is going to gobble up Knight. So if you assume that a merger or an acquisition or a takeover is going to happen at a premium to the current stock price, and you assume that Party A can take over Party B, thereby raising the price of Party B stock, but Party B could never really take over Party A, therefore Party A stock can't really go up. It would seem that you want to be in the position of owning the company that's the target as opposed to the acquirer. For the reasons of mergers, there's a significant reason why I like Marten more than I like Knight Transportation. There's a number of new technologies coming out that I think could have really significantly impact this industry. One of them is self-driving cars. Obviously, if we can get drivers out of these trucks, it's going to be a massive difference in the profitability of these companies. The truck drivers are a significant cost. They're also a significant inhibitor to productivity. A self-driving car, in theory, could drive 24 hours a day and is going to have less accidents. You're not going to be paying the drivers. It's going to be more efficient. It's going to be safer. So you add all those things up, and self-driving technology could revolutionize trucking. You'd like to think that companies that are big in the trucking industry will be the beneficiaries of that. I can't see how they won't. And so that's one of the issues. But a second issue is the issue of Tesla and their electric semis. These have a significant opportunity to really impact this industry. The speed that I drive from my house to Flagstaff in northern Arizona every weekend in the summer. And while I'm doing that, I'm driving past these semis going 35 miles an hour going up these mountains. They just don't, diesel semis do not take high grade very well, very quickly, and they go much slower. Well, every minute they're going slow is a minute of lost productivity or reduced productivity. There are routes where trucks will go around the route and drive significantly out of their way to avoid going through areas of the Rockies, for example. The electric semi can go up a 5% grade at 60 miles an hour. That's a significant increase in performance. In addition, their acceleration is significantly faster. The 0-60 speed at a full semi is about 20 seconds, and it's far, far faster than a diesel engine. And again, when you start thinking about driving in and out of traffic, going up and down hills, whatever you're doing in a semi, every time you have to accelerate, that's just lost productivity. Finally, there's obviously fuel savings. It's estimated that a semi over the course of its course of useful life will pay for itself in fuel savings. So these are all things which created the benefit of companies that are able to get on the bandwagon with new technology. Now, who's that going to serve better? Knight Transportation or Marten Transportation? That's really the question. I've spent a lot of time thinking about that. So we'll talk about that in the next slide. So in addition to being more effective in terms of fuel, we think it'll be easier to train truck drivers, and thus that will increase the universe of people who can drive these trucks. An electric engine driven semi has no gears, whereas a semi has 12 to 18 gears. It's a lot to figure out and to handle while you're driving these big trucks. So if we can expand the universe of capable drivers, that should reduce what we have to pay those drivers. And if we can make it easier and easier to drive them, it's less stress on the drivers. And again, self-driving technology solves all of those problems. The thing to keep in mind, though, is that this is likely to just create an arms race, right? It's like one guy's going to go buy an electric semi and reduce his costs and thus be more competitive and take more market share. So his competitor has to go and buy an electric semi. And pretty soon, everybody's got an electric semi. And all they've done is reduce their costs, and they're passing all those costs on to the consumers. And so there's this arms race where nobody really wins. And that may well come to pass. But even in that case, I think Marten is the beneficiary of that. So why is Marten a beneficiary of this arms race? Well, it seems that Tesla believes it can produce 100,000 trucks annually. Assume that's correct. And assume that electric semis do create a real competitive advantage, and that you effectively have to have an electric semi, and every semi that you have that's electric gives you a competitive advantage, thus more profit to your shareholders. Marten needs 2,500 new trucks to replace its fleet. That's 2.5% of Tesla's annual production, so less than a month. It's really a week's worth of production. And they could replace every single truck in their fleet if they wrote the check. Knight needs 23,000 new trucks. That's an awful lot of trucks. It's a quarter's worth of production, and that assumes that nobody else wants to do the same thing. So it seems to me that Knight could, if they chose to, if it was beneficial to them, they could flip their entire inventory of trucks in almost instantly, and that's going to give them a competitive advantage for a series of years over Knight Transportation. Also, at roughly $200,000 per truck, Marten needs to invest $500,000 to replace its fleet, whereas Knight needs to replace $4.6 billion to replace its fleet. Now remember, Knight has a market cap of just over $5 billion. So effectively, they have to spend their entire market cap to replace their trucks. Knight's market cap is about $1 billion, so they have to spend about half of their market cap. And so because they can A, replace their fleet faster, B, they can do it in a way that doesn't require the taking on of such massive amounts of debt, it does seem to me that new technology is more likely to benefit Marten than it is to benefit Knight. So I've talked in the past about how I measure these companies in 29 areas, 9 operating areas, 10 financial areas, and 10 management areas. Operating being, how good they are delivering their goods and services and generating profits. Financial being how good are they at managing their resources, taking on debt and managing risk. And management is a measurement of how good they are at returning money to the shareholders. And so here you can see my scores. I rate every company from 1 to 4, 4 being the highest and 1 being the lowest. And you can see when you look at this that while I've rated Knight as average in most categories, I've put Marten as significantly above average in most categories and excellent in many, especially in all the financial categories since they have no debt. So when you look at this chart, you can see that it just does appear that Knight Transportation's total GPA is 3.17, and the total GPA Marten's Transportation is 3.17, and the total GPA for Knight Transportation is 2.62. So when looked at in its totality, again, I think the advantage goes to Marten. So I think that it's important to say that I think these are both solid companies. I wouldn't mind owning either of them, but you shouldn't own both. You should choose one, and you should have a logical reason for why you would choose one. And you may choose to focus on different things than I do, and you may decide Knight's a better opportunity because they're going to continue to gobble people up and grow like Wayne Huizinga used to grow companies. And I can't argue with that logic, but I'll stick with the tried and true, and I'm just doing what Warren Buffett tells me to do. And I like no debt, and I like the fact that if somebody buys somebody, we're likely to be the guys getting bought. And I may end up being a shareholder in Knight Transportation by virtue of a purchase. So that's sort of my analysis of these two companies. So I've told you to buy now 4 companies. Altria Group, which I told you to buy on the 4th of February. T. Rowe Price, which I told you to buy on the 15th of February. Argan, which I told you to buy on the 22nd of February. And Marten, and when I did this analysis, it was the 8th of March, and I haven't posted it yet, but I'm posting it today. Since the day I told you to buy that, we bought about $10,000 worth, and the profits, Altria is up about $1,300, and T. Rowe Price is up $290. Argan is up $361. So these companies are up, about 13%, about 3%, and about 3.5%. And Marten, again, is just kind of floated around the few days since we bought it. So in total, you'd have invested about $40,000, and you'd be up about $2,100, so you'd be up about 5% if you'd been following me for a month. I don't consider that trend's likely to continue at that rate, but we are performing well, and we'll continue to track these things week in, week out as we continue to suggest investment ideas. Thank you very much for your time.